Fuel prices are climbing again, but not because of some dramatic event dominating the news cycle. The real driver is quieter and easier to miss, from daily commuters filling up before work to businesses moving products across the continent. The strain is starting to show. This isn't just another short-term jump at the pump. It points to a deliberate shift unfolding behind the scenes, one that exposes an unexpected reality about where power in North America's energy market really sits. Gas prices are climbing again, but this time the trigger isn't an obvious global emergency or a dramatic event dominating the headlines. The force behind the increase is quieter, slower, and far easier to overlook. Yet across the United States, its effects are becoming harder to ignore. From commuters filling up before sunrise to companies moving freight across thousands of miles, a steady strain is building through the system. What we're seeing is not a random jump in fuel costs. It reflects a deliberate shift in economic pressure, one that reveals an uncomfortable truth about where real leverage in North American energy may actually lie. At T stations across the country, drivers are watching fuel totals rise with frustration. For many households, it no longer feels like a routine market fluctuation. The burden is spreading well beyond personal vehicles. Trucking companies, airlines, agricultural producers, and other fuel-dependent industries are all feeling the squeeze in ways that cut directly into operating margins. What makes this moment especially striking is that there has been no single disaster or war dominating the explanation. No dramatic supply collapse, no sudden international shock. That absence of noise is precisely what makes the development so revealing. The larger story may not be the higher price itself, but the unseen influence making that higher price possible. Many Americans still assume the U.S. economy is too large and too productive to be seriously pressured in this way, but energy systems don't always follow political mythology. Beneath the language of strength and self-sufficiency sits a more delicate reality, one shaped by infrastructure, dependency, and long-built supply relationships. To understand why that matters now, it helps to revisit the return of trade friction during the tariffs-entered approach associated with Donald Trump. When those tensions re-emerged, many expected Canada to answer with overt retaliation, speeches, countermeasures, and visible political confrontation. Instead, the response appeared to take a more restrained and highly targeted form. Rather than escalate publicly, Ottawa seemed to lean into the mechanics of the market itself. The pressure did not arrive through dramatic declarations. It emerged through the quieter tools that often matter more: pricing formulas, transportation charges, contractual adjustments, and the subtle addition of risk into the cost of oil moving south. At first glance, those changes looked minor, too small to attract widespread attention. But in the energy sector, even narrow cost shifts can ripple outward with enormous force. What begins as a technical adjustment upstream can end as a visible burden for consumers, businesses, and supply chains across an entire country. The first cracks typically appear where margins are thinnest and sensitivity is highest. Refiners begin to feel the pressure before the public notices anything unusual. Distributors follow. Then, once those additional costs have nowhere else to go, they are passed on to the market. By the time drivers see the numbers change at the pump, the financial effect has already worked its way through multiple layers of the economy. That process exposes a paradox at the center of America's energy story. The United States may produce enormous volumes of oil, but production leadership does not erase import dependence. A large share of imported crude still comes from Canada, making the relationship not merely important but structurally embedded. The key issue is not just quantity, it is compatibility. Much of the crude Canada exports is heavy crude, a thicker, denser type of oil that requires specialized refining capacity. Over time, major refineries in the Midwest and along the Gulf Coast were built or upgraded specifically to handle that kind of feedstock. Those facilities were not designed with unlimited flexibility in mind. They cannot simply swap in lighter domestic crude from places like Texas or North Dakota without costly modifications, lengthy planning, and major capital investment. In other words, the supply relationship is locked in not only by contracts but by steel engineering and decades of industrial design. That is where the leverage becomes clear. If a supplier understands that its product cannot be easily replaced, it does not need to cut off access to exert pressure. It can keep the flow moving while changing the economics around that flow by nudging premiums upward, reworking fees, or recalibrating transport-related costs. The supplier can preserve continuity while shifting bargaining power. That appears to be the deeper lesson here. The oil keeps crossing the border, yet the financial advantage begins to move. And because American refiners have limited room to maneuver, they are often left absorbing the increase until they can't once refiners. And distributors reach the point where absorbing losses is no longer viable. The pressure spills outward. Diesel becomes more expensive. Freight becomes more expensive. Delivering food, industrial materials, manufactured goods, and consumer products becomes more expensive. Inflationary pressure doesn't always begin with a dramatic announcement. Sometimes it arrives one transport invoice at a time. Rural communities tend to feel this especially hard. People in those regions often travel longer distances, rely more heavily on personal vehicles, and live in local economies closely tied to farming, equipment, and diesel-intensive work. For them, fuel is not optional overhead. It is an essential operating condition of daily life. What makes this episode so significant is that it doesn't resemble a conventional crisis. There is no single day that historians can point to and say, that was the moment everything changed. Instead, it unfolds as a gradual recognition of dependence. It raises a deeper question about economic conflict in an interconnected world. Who holds more real power, the country that announces tariffs, or the one that controls a resource the other side cannot easily replace? The answer is rarely straightforward, but one thing becomes obvious. Influence does not always arrive through speeches, sanctions, or public confrontations. Often it travels silently through pricing structures, supply contracts, and embedded industrial assumptions. Observers outside North America have taken notice. In Europe, some analysts have viewed Canada's approach as a sophisticated example of calibrated economic pressure, firm enough to protect national interests, yet restrained enough to preserve diplomatic credibility. In Asia, where energy security remains a constant strategic concern, the lesson is being watched through another lens. Even relationships that appear stable can become vulnerable when politics collides with infrastructure. Nations that depend heavily on imported energy are seeing another reminder that resilience is not just about buying supply, but about diversifying it before leverage becomes visible. For policymakers in Washington, this situation exposes an uncomfortable contradiction in the rhetoric surrounding energy independence. Producing more oil at home is not the same thing as being fully insulated from outside pressure. A nation can lead in production and still remain exposed if its refining system depends on specific grades of imported crude. That distinction matters enormously, and it is now becoming harder to ignore. Industries with high fuel and petrochemical exposure, including aviation, manufacturing, freight, and chemical processing, have increasing reason to worry about what prolonged cost pressure could mean for competitiveness and pricing. That reality is feeding a broader debate in the capital. Some argue that energy-related exceptions or adjustments may be necessary if trade tensions are going to continue without harming domestic industry. Others warn that any carve-out would weaken the broader political strategy behind tariffs in the first place. But whatever direction the policy argument takes, the underlying message has already been delivered. Canada has shown that essential access can be shaped, priced, and strategically managed even without crossing the line into outright disruption. In modern economic competition, control over critical inputs can matter just as much as headline economic size. This may also be part of a wider international pattern. Resource-rich countries are learning that they do not always need loud confrontation to defend their interests. Markets themselves can be used as instruments of statecraft. That approach is quieter, less theatrical, and often more effective because it works within the normal operations of trade rather than outside them. It reflects a changing world in which leverage is increasingly defined not just by GDP or military reach, but by whether your resources are woven directly into another country's supply chain, industrial base, and daily survival. Looking ahead, both sides face difficult choices. The United States can either rethink trade strategy in a way that accounts for hard infrastructure realities, or continue accepting the economic drag that comes from ignoring them. Canada, meanwhile, must weigh the advantages of its current position against the long-term risks of depending so heavily on a single export market. That is the deeper lesson of this moment. In a tightly integrated economic system, dependence always runs in more than one direction. And when policymakers reach for trade weapons without fully understanding the networks beneath them, the consequences rarely unfold the way they expect. What looks like a simple rise in fuel prices may actually be evidence of something much larger. a quiet contest over leverage, dependence, and strategic patience. It is a reminder that in the modern economy, power is often exercised most effectively when it is least visible.